Ever felt like you need a secret superpower to cut through mountains of information, find the real gems, and truly connect the dots?
Uh-huh.
Well, today you're getting a front row seat to exactly that kind of superpower.
Yeah.
We're taking a deep dive into something that sounds incredibly technical, but really underpins all financial integrity.
Yeah.
An auditor's profound understanding of an entity and its environment.
Right.
Trust me, by the end of this, you'll see the intricate, almost dance-like relationship between a company's inner workings, the broader economy, and, well, the crucial insights an auditor must unearth.
Yeah, and our mission for this deep dive is really to equip you with the foundational understanding of how auditors meticulously build this comprehensive picture of a company. We're talking everything from its internal gears and cogs, to the vast external forces constantly shaping its destiny. We'll explore the vital why behind this deep understanding, the practical how through various investigative procedures, and the specific what factors that get considered, including, and this is key, a crucial look at how economic principles are woven into this complex tapestry.
Okay, let's unpack this then. Why is knowing a company inside and out, I mean, beyond just its balance sheet, why is that so absolutely critical for an auditor? It's not simply about checking if the numbers add up, is it?
No, no, it's far more than just a numerical check. See, the fundamental purpose of this deep dive into an entity's environment, its whole world, is to proactively identify and assess the risks of material misstatement in its financial statement.
Serial misstatement, right.
Yeah, and imagine material misstatement as like an error or an omission in the financial reports that's so significant, could actually sway the economic decisions of someone relying on those statements, say, an investor deciding whether to buy shares, or maybe a bank considering a loan.
Got it. So it has real consequences.
Absolutely. For an auditor, understanding these potential risks is the bedrock, the foundation for ensuring those financial statements are accurate, reliable, and truly reflect the company's real financial health. I mean, without this comprehensive understanding, an auditor would pretty much be navigating blind, unable to effectively pinpoint where problems might lurk.
So it's kind of like a seasoned detective showing up at a crime scene. They don't just randomly search, right? They first need to understand the dynamics, the key players, the potential motives, the environment, just to know exactly where to focus their search for clues.
That analogy is spot on.
Yeah. So how does that deep understanding then directly influence the critical audit decisions they have to make?
Well, that intricate understanding, it permeates every single critical decision an auditor makes throughout the entire engagement. First off, it directly shapes how they determine materiality and tolerable misstatement. And what's fascinating here is that materiality isn't some fixed threshold. It's a nuanced judgment call. What's considered significant enough to influence a user's decision for, say, a small local business is vastly different from what's significant for a giant Fortune 500 multinational.
Right. Context matters.
Exactly. The auditor uses their deep entity knowledge, their understanding of this specific company, to set the precise level of error that actually matters, making sure their focus is on what truly impacts the financial picture.
So it really helps them calibrate what significant actually means for that company. That sounds crucial.
It is. And second, this understanding informs the auditor's evaluation of the company's accounting policies, how it chooses and applies its specific rules for recording transactions.
Like their playbook.
Sort of, yeah. Are the accounting methods appropriate for this business? Are they applied consistently from one period to the next? Knowing the entity helps the auditor figure out if the company is using policies that authentically fit its operations, or if, maybe, they might be trying to obscure a less favorable financial reality.
Okay. Third, this comprehensive view is absolutely vital for identifying significant risks. These are areas in the financial statements that just have a higher inherent likelihood of material misstatement, and so they demand more rigorous audit attention.
Makes sense.
For example, a company operating in a highly volatile, rapidly evolving industry, or maybe one with really complex revenue recognition from long-term contracts that might immediately present higher significant risks that require a very focused approach from the auditor.
Right.
Fourth, it's indispensable for developing strong expectations for analytical procedures. An auditor can't just glance at financial ratios or trends in isolation. They need a benchmark, an informed expectation of what those numbers should look like, based on their deep understanding of the company's operations, its industry, and the broader economic climate.
Okay, so what it should be versus what it is. Precisely. If, for instance, a company's sales are suddenly skyrocketing in an industry that's otherwise declining, That's not just a red flag. It's an immediate prompt to ask, is this some groundbreaking innovation, or could it potentially be a desperate attempt to inflate numbers? That divergence alone is a powerful insight, pointing directly to areas susceptible to misstatement.
So these procedures really serve as an early warning system then, helping them home in on anomalies?
Precisely. And fifth, and arguably most critically, this deep understanding directly guides the design and execution of all further audit procedures.
Okay.
This includes designing tests of controls, which check if the internal systems and processes a company has in place to prevent or detect misstatements are actually working as intended. And it also directs the design of substantive procedures, which are the direct tests of account balances and transactions to verify their accuracy. This profound understanding allows the auditor to tailor their audit plan, making it both efficient and effective, focusing resources where the risks are highest. And finally, it enhances the auditor's ability to evaluate the audit evidence they gather. Knowing the company and its operating environment helps the auditor assess the reliability and relevance of the evidence itself. Does this piece of evidence align with what we already understand about the company's business model? Does it make logical sense within the context of its overall operations? Without this integrated understanding, evaluating evidence becomes a much more challenging and, frankly, less effective process.
Okay, so we understand the why now. Let's pull back the curtain a bit and look at the auditor's actual toolkit. How do they go from needing this deep insight to actually getting it? What methods are they using?
Right. Well, auditors deploy a pretty comprehensive suite of procedures designed to be as thorough and unbiased as possible. And this isn't about looking for what you want to find. A key principle here, a real pass-key concept, is that these procedures should not be biased towards obtaining only corroborative evidence. They must also actively seek out contradictory evidence.
So looking for things that don't fit, too.
Exactly. It's about getting the complete, unfiltered picture,
Yeah.
even if some parts of it are unsettling or unexpected.
This really does sound a lot like investigative journalism or detective work. Who are they actually talking to, and what kind of questions are they asking?
It absolutely is like detective work, and the primary tool in this investigation is inquiries. Basically, detailed conversations with a wide array of individuals, both inside and outside the entity.
Okay.
This isn't just a quick chat with the CEO. Inquiries extend to management, of course, but also to those directly responsible for financial reporting and many others throughout the organization. The importance lies in seeking varying perspectives.
Different viewpoints.
Exactly. This means inquiries should reach different levels of authority and span across various departments. You're talking to IT personnel to grasp how data flows through systems, marketing staff to understand sales strategies, risk management to learn about identified threats, maybe even in-house legal counsel to assess litigation risks. Each person offers a unique piece of the overall puzzle. But it doesn't stop within the entity's walls. Auditors also reach out to external parties, like external legal counsel, who might have knowledge of ongoing lawsuits, or perhaps independent valuation experts, who can shed light on complex asset valuations. These external perspectives are crucial for a complete and objective picture, providing an independent lens on the company's operations and financial health.
Right.
And if an entity has an internal audit function, which is pretty common in larger organizations, discussions with these internal auditors can provide invaluable insight.
Because they're already inside.
Yeah, they're already performing their own reviews of operations, business risks, and internal controls. This raises an important question. What can we learn from those already looking deep inside the company? Their findings and insights into the entity's own risk assessment outcomes are particularly relevant to the external auditor.
Makes sense.
However, and this is vital, inquiries alone are rarely enough. What people say needs to be corroborated or sometimes even challenged. That's why auditors must ensure their risk assessment procedures also include observation and inspection, looking at documents, watching processes.
Seeing it for themselves.
Exactly. These procedures are essential to support, confirm, or sometimes even contradict what's heard during inquiries, adding a vital layer of verification to the verbal information.
Numbers can tell an incredible story, can't they? What kind of narratives are auditors trying to uncover when they dive into the data?
They absolutely can. And analytical procedures are all about decoding those numerical narratives. These involve evaluating financial information by studying plausible relationships between both financial and non-financial data. It's about seeing if the numbers logically connect to each other, and importantly, to the real-world activities of the business. During the planning phase of an audit, analytical procedures often involve a high-level review of aggregated data. This could be as straightforward as comparing current financial statements to prior periods, or maybe to budgeted
With
results.
year-over-year comparisons.
Exactly. The data primarily includes financial figures,
Yeah.
like changes in the unadjusted trial balance from one year to the next. But it's also crucial to incorporate relevant non-financial data. For instance, an auditor might compare changes in the number of employees, or the square footage of selling space, or the volume of goods produced, and then cross-reference those with corresponding financial figures like revenue or payroll expenses. This helps quickly identify any glaring disconnects. The complexity can vary a lot, from simple year-over-year comparisons to detailed monthly or quarterly analyses, using everything from basic spreadsheets to really sophisticated audit data analytics software that can process massive data sets.
So these procedures really help them quickly zero in on unusual patterns or potential red flags.
Exactly. They enhance the auditor's understanding of the entity and any significant transactions or events that have occurred since the last audit. More importantly, they are designed to flag unusual transactions and events, unexpected relationships between numbers or trends that might be indicative of a material misstatement.
Okay.
This is where they become a powerful tool for identifying risks, particularly those related to fraud. For instance, if a company's reported revenue growth suddenly jumps far beyond industry norms without a corresponding increase in production or marketing spend, well, that immediately signals a need for closer examination.
Right.
And there's a crucial requirement here, another passkey. During planning, the auditor is specifically required to perform analytical procedures related to revenue.
Why revenue specifically?
Because revenue recognition is an area frequently susceptible to manipulation. So this specific analysis helps identify any unusual or unexpected relationships that might indicate a material misstatement, including those due to fraud. Auditors also consider any analytical procedures performed during interim reviews, if those have happened.
Auditing definitely isn't a solo endeavor, is it? How does the audit team collaborate on this risk assessment? Is it like a big group brainstorming session?
It's absolutely a team sport, and open communication is paramount. The risk assessment discussion is a crucial element. This involves the entire audit team, including the auditor, with final responsibility for the audit, other key members, and maybe even specialists if needed, like IT auditors or valuation experts.
Getting everyone in the room.
Exactly. The core of this discussion is to collectively apply the applicable financial reporting framework, like GAAP in the U.S. or IFRS globally, and to thoroughly consider the susceptibility of the financial statements to material misstatement. It's really a dedicated brainstorming session aimed at identifying potential pitfalls and challenges ahead. Professional skepticism is absolutely non-negotiable during this team discussion. It's not just a buzzword. It's a mindset that encourages every team member to rigorously investigate potential misstatements, whether they're due to genuine error or deliberate fraud.
And that raises an important question. How do you actually foster that skeptical mindset within a team? It seems tricky.
It is. It involves creating an environment where open questioning, challenging assumptions, and not taking anything at face value are not just accepted, but actively encouraged. It's about psychological safety, allowing people to speak up.
Right.
In terms of logistics, this discussion can often be held concurrently with the dedicated fraud risk discussion, as the two are closely related. If the audit involves multiple locations or complex group structures, there might need to be multiple discussions to ensure all relevant information is shared. And it's essential that any important matters identified are communicated to all engagement team members, even those who weren't present for that specific chat.
Okay, keeping everyone looped in.
Definitely. Key discussion points usually include significant audit risks identified, the company's specific selection and application of accounting principles, including disclosure requirements, areas involving unusual accounting procedures, the effectiveness of important internal control systems, and the precise materiality levels set for the audit. This fosters invaluable knowledge transfer, allowing more experienced team members to share their insights with less experienced staff, leading to a more robust and informed risk assessment overall.
And it's not just a one-off meeting at the start.
No, absolutely not. This isn't a one-time event. It's an ongoing process that continues throughout the audit, adapting as new information comes to light or conditions change. And beyond these core procedures, auditors also consider a range of other procedures to gain insight. This includes reviewing external information, things like trade journals specific to the client's industry, or analyst reports that offer independent perspectives on the company's performance and outlook.
Outside views.
Exactly. They also factor in the results of the Dedicated Fraud Risk Assessment, which is a structured process aimed at identifying and assessing risks of material misstatement due to fraud. Information obtained during the initial client acceptance or continuous process, essentially. The initial decision to take on or continue auditing a client provides foundational knowledge about the entity. And finally, information from prior engagements for the same entity and prior period audit evidence is carefully reviewed, provided, of course, it's still relevant to the current period's audit.
Okay.
It's also worth noting that these risk assessment procedures can sometimes incidentally provide direct audit evidence about transactions, balances, or controls. While that's a nice bonus, it's not their primary purpose. Auditors might also choose to perform substantive procedures or tests of controls concurrently with risk assessment procedures if it makes the audit more efficient.
So this whole picture of the company isn't static then, but something that constantly evolves and adapts throughout the entire audit process.
Absolutely. Risk assessment is a dynamic, continuous process that evolves throughout the audit. The auditor's initial assessment of risk is never set in stone. It might change as additional audit evidence is obtained.
For example?
Well, an auditor might initially presume that certain internal controls are operating effectively. However, later tests of controls might indicate that these controls aren't actually operating as expected at relevant times during the period. Or perhaps the auditor detects misstatements in amounts or with a frequency greater than what was initially expected given the preliminary risk assessment.
Okay.
In situations like that, the auditor is required to revise their assessment of risk and, crucially, modify the planned audit procedures to address the newly identified or elevated risks. It's an iterative process of continuous learning and adaptation.
And does the approach change much for, say, a small startup versus a huge multinational corporation? Size must matter here.
Well, definitely. In terms of scalability considerations, the audit approach indeed changes significantly based on the entity's size and complexity. The way a system of internal control is designed, implemented, and maintained looks very different for a small startup compared to a multinational corporation.
How so?
Well, a less complex entity, for instance, may use far less formal means to achieve its control objectives. It might not have extensive written policies and procedures manuals or an independent audit committee, Instead, its management might be much more actively involved in the day-to-day financial reporting. Or the company might have a strong corporate culture emphasizing integrity that serves as a powerful informal control.
Right, the tone at the top.
Exactly. But regardless of the formality, the auditor must use their professional judgment to understand the components of the system of internal control and make an overall assessment of control risk, tailoring their approach to fit the client's unique structure and operational realities.
This feels like where we really get into the nitty-gritty. What specific aspects of a business does an auditor meticulously examine to build that truly complete picture we've been talking about?
Right, this is digging into the what. This deep understanding of the entity and its environment is paramount because it establishes the essential frame of reference for planning and performing the entire audit. It helps the auditor identify events and conditions that are directly relevant to the entity's financial statements and, crucially, helps to identify how inherent risk factors might affect the susceptibility of those financial statements to misstatement.
Okay, remind us quickly, inherent risk factors.
Yeah, when we talk about inherent risk factors, we're referring to characteristics that make something inherently more vulnerable to error or fraud before you even consider any internal controls the company might have in place.
Got it. Before controls.
Exactly. The exact extent of this understanding is left to the auditor's professional judgment. But it must be sufficient to effectively assess the risk of material misstatement, design and perform further audit procedures, exercise professional judgment, and maintain professional skepticism throughout the engagement. And, naturally, they must always consider any significant changes from the prior audit period.
So it's almost like understanding the very DNA of the company. What makes it tick?
Precisely. Understanding the nature of the entity is foundational. This involves obtaining a clear picture of its organizational structure, how it's formally set up, who reports to whom. It also encompasses ownership and governance, who ultimately controls the company and how it's managed, including the role and composition of the board of directors.
Who's in charge?
Right. The auditor must also grasp the company's business model. How does it actually make money? What are its primary revenue streams, its core products or services, and its main cost drivers? And increasingly important today, The extent to which information technology, or IT, is integrated into every facet of the entity's operations. Understanding these complexities helps the auditor identify and assess potential risks of material misstatement across various areas of the client's business.
Okay.
Now, for publicly traded entities, often called issuers, the standards from the Public Company Accounting Oversight Board, or PCAOB, provide even more specific procedures.
Like what?
Well, the auditor should carefully read public information about the entity, annual reports, press releases, which can offer valuable insights into the likelihood of material financial statement, misstatement, and the effectiveness of internal controls.
Oh.
They observe or read transcripts of earnings calls and other public meetings with investors and ratings agencies. These are often gold mines for understanding management's stated perspective and any external pressures they might be facing.
Listening in.
Exactly. Auditors also need to understand compensation arrangements with senior management, including incentive compensation structures, any changes to those, and special bonuses. This is crucial because performance-based compensation can inadvertently create incentives or pressures for management to manipulate financial results.
Right, the motivation factor.
Precisely. They also obtain information from Securities and Exchange Commission, or SEC, filings and other sources about trading activity in the entity's securities and holdings by significant shareholders, which can sometimes signal potential insider issues or concentrated control. They make inquiries of the chair of the Compensation Committee and any consultants regarding executive officer compensation structuring to understand the rationale behind specific incentives.
Yeah.
And finally, they get an understanding of the company's established policies and procedures regarding the authorization and approval of executive officer expense reimbursement.
And here's where it gets really interesting, right? Because these details give real insight into management's motivations and potential pressures.
Absolutely. These seemingly small details can reveal so much about management's underlying motivations and potential pressures, giving us early clues about where fraud or misstatement might be more likely to occur.
Every company sets ambitious goals, of course, but what happens when those goals hit a snag? Or maybe a business takes a wrong turn?
That's precisely where objectives, strategies, and business risks come into play. An entity's objectives are its overarching plans, its grand aims. Its strategies are the specific means it employs to achieve those objectives. Business risks, then, are the events or circumstances that could adversely affect the entity's ability to achieve those objectives and successfully execute its strategies.
And the link to misstatement.
Well, the connection to financial misstatement is quite direct. If management has inappropriate objectives or strategies, or maybe if they fail to recognize the need for a strategic pivot in a dynamic environment, it can significantly increase the susceptibility of the financial statements to misstatement. This is particularly true when there are intense incentives or pressures on management, perhaps tied to meeting aggressive performance targets, which can lead to either intentional or unintentional bias in financial reporting.
Can you give some examples of how these business risks might lead to misstatement?
Sure. Let's consider some concrete examples. Think about industry developments. If an industry is undergoing rapid technological change or facing intense new competitive pressures, the entity may simply not have the personnel or expertise to deal with these shifts effectively. This could lead to misstatements if the company struggles to adapt its operations, or if a core product rapidly becomes obsolete, impacting inventory valuation or future revenue projections. When a company launches new products and services, there's often a significant increase in product expense or related liabilities for things like warranties or returns. If management is under pressure, they might fraudulently underreport these expenses or liabilities to present a better financial picture.
Right.
Similarly, expansion of the business often comes with its own set of risks. If demand hasn't been accurately estimated, the company could end up with an excess of inventory, leading to significant write-downs that might be concealed or misstated. New accounting or regulatory requirements can also introduce significant risks. Improper or incomplete implementation of new accounting standards can directly lead to misstatements. Increased regulatory scrutiny or new laws can heighten legal exposure, which might not be adequately disclosed or provisioned for in the financial statements. Current and prospective financing requirements are another key area. If an entity is unable to meet the requirements of its lenders, it could lose crucial financing, leading to severe liquidity issues and potential misstatements related to the company's ability to continue as a going concern. The effects of implementing a new strategy, particularly any that lead to new or complex accounting requirements, need careful attention to ensure proper financial reporting.
And IT.
The entity's use of IT is now pervasive. Implementing a new IT system can profoundly affect both day-to-day operations and financial reporting. If not managed properly, system implementations can lead to data integrity issues or control deficiencies, increasing the risk of misstatement throughout the financial reporting process.
And climate.
Yeah, and a timely example, climate-related events.
Yeah.
These are no longer just environmental concerns. They can severely impact an entity's ability to obtain financing, attract investors, or retain customers, all of which have direct financial implications that auditors must consider. For instance, a company operating in a region prone to severe weather events might face increased insurance costs, significant operational disruptions, or asset impairments that need to be accurately reflected in the financial statements.
So it's kind of like an auditor needs to understand the specific rule book a company plays by and how consistently they're sticking to it, or maybe if they're bending the rules a bit.
Precisely. We're talking about the selection and application of accounting policies. The auditor's focus here is twofold. First, to thoroughly understand the entity's chosen accounting policies and the specific way they apply them, including the reasons behind any changes to those policies from one period to the next. Second, the auditor then rigorously evaluates whether these accounting policies are genuinely appropriate for the entity's specific business operations and whether they are consistent with the applicable financial reporting framework, like GAAP or IFRS, and with common accepted practices within the industry in which the entity operates.
Right.
Special attention is paid to understanding significant accounting policies, particularly those areas where there's maybe a lack of clear authoritative guidance or a broad consensus in practice. These are often the areas that involve significant management judgment and thus inherently carry a higher risk of misstatement. Additionally, the auditor needs to understand how the entity recognizes and reports significant or unusual transactions, as these can be complex and especially susceptible to misstatement or even manipulation. The impact of any new financial reporting standards that are new to the entity is also a critical consideration, as improper adoption can lead to widespread misstatements.
Management is obviously driven by performance metrics, but how does an auditor look at that performance differently, maybe with a more skeptical eye?
Well, management certainly evaluates the entity's financial performance against its desired objectives. For the auditor, gaining a deep understanding of this management review process is absolutely crucial because it can directly indicate a heightened risk of misstatement.
I hope so.
For example, in situations where management receives performance-based compensation bonuses tied to achieving specific revenue targets, profit margins, or stock price goals, unusual or aggressive growth or profitability might raise a red flag. It could be indicative of management bias in the financial statements.
Right.
This bias could be intentional, leading to fraud, or unintentional, maybe stemming from overly optimistic judgments in complex areas.
Okay, so how do they figure out those pressures?
To fully grasp the entity's performance drivers and identify potential incentives or pressures that could lead to misstatement or fraud, the auditor considers several specific factors. They meticulously look at measures that form the basis for contractual commitments, like loan covenants with banks, or the triggers for incentive compensation arrangements for executives. These are the numbers that directly impact management's pockets or the company's ability to secure financing. They also consider measures used by external parties, such as financial analysts and credit rating agencies, to review a company's financial performance. If a company is consistently missing analyst expectations or its credit rating is at risk, management might feel intense pressure to manipulate results.
Makes sense.
Finally, auditors analyze key performance indicators, both financial and non-financial. Non-financial KPIs could include things like customer satisfaction scores, production efficiency metrics, or website traffic, all of which can provide a broader context for interpreting financial results and spotting inconsistencies. And this entire understanding of the industry, the regulatory environment, the entity's nature, its objectives, strategies, business risks, and financial performance, this directly aids the auditor in assessing the entity's overall inherent risk. It's all interconnected, providing a holistic view of where the vulnerabilities might lie. Now, when it comes to understanding the group, its components, and their environment, there are specific and unique considerations for group audits, like multinationals with subsidiaries all over the place.
Right, more complex.
Much more. The group engagement team needs to significantly enhance its understanding of the entire group structure, all its individual components or subsidiaries, and their respective operating environments, including any group-wide controls that might span across different entities. They must also obtain a thorough understanding of the consolidation process, how the financial results of all those separate entities get combined into one cohesive set of group financial statements, including any specific instructions issued by group management to its components regarding reporting. This also involves confirming or revising the initial identification of significant components, which are those parts of the group that, either individually or collectively, are financially significant or carry specific heightened risks of material misstatement to the overall group financial statements.
We've talked about inherent risk generally, but what are the very specific characteristics that make something inherently riskier? What are the factors that really scream caution to an auditor?
That's a great question, because inherent risk isn't just some vague feeling. It's rooted in specific characteristics of events or conditions. Inherent risk factors are traits that affect how susceptible an assertion about a class of transactions, an account balance, or a disclosure is to misstatement, whether that's due to error or fraud. And importantly, remember, this is before considering any internal controls the company has in place to mitigate those risks. These factors can be qualitative or quantitative.
Okay, so what are some key ones?
Let's break down some of the key factors that raise an auditor's antenna. Complexity refers to transactions or calculations that are intrinsically difficult to understand, process, or account for. Think of highly complex financial instruments, multi-tiered revenue recognition schemes, or intricate tax calculations spanning multiple jurisdictions.
Right, tricky stuff.
Exactly. Subjectivity arises when the accounting relies heavily on management judgment or estimates, such as valuing certain intangible assets, determining future warranty provisions, or estimating the collectability of long-term receivables.
Judgment calls.
Change is a huge one. A rapidly evolving industry environment, the implementation of new systems, new regulations, or significant shifts in the business model can all introduce higher inherent risk. Uncertainty relates to situations where future outcomes are inherently unclear, such as the outcome of pending litigation or highly speculative economic forecasts affecting asset impairment. Management bias or fraud risk is a direct and critical factor, particularly when there's intense pressure to meet financial targets or strong incentives tied to financial results. Significance refers to items that are very large in amount or are high profile, drawing more attention and potentially being targets for manipulation.
Big numbers.
Right. Finally, volume or lack of uniformity means either a high volume of similar routine transactions, like daily sales, where errors can aggregate quickly, or conversely, a few highly varied non-routine transactions, like a one-off complex merger or acquisition, which can be difficult to account for correctly.
Got it.
And these factors are often closely related. For instance, if an accounting estimate requires significant judgments due to its inherent subjectivity, the measurement of that estimate is likely also affected by a high degree of uncertainty. The greater the extent of complexity or subjectivity, the greater the need for the auditor to maintain professional skepticism, because these inherent risk factors create more opportunities for either intentional manipulation or unintentional management bias to creep into the financial statements.
Today, it's practically impossible to imagine a business running without technology. I mean, it's everywhere. How does this pervasive IT environment factor into an auditor's deep dive?
You're absolutely right. IT is now the digital backbone of virtually every business. Understanding the IT environment is totally non-negotiable. Information technology encompasses all automated means of originating, processing, storing, and communicating information. Crucially, the use of IT profoundly affects how transactions are initiated, recorded, processed, and reported within a company. This means an entity's reliance on IT profoundly impacts both the design and implementation of its internal control system, and consequently, the audit procedures auditors use to gather evidence.
So digital evidence is key now.
Increasingly, yes. A significant implication is that much of the audit evidence collected today may be in digital form, which requires the auditor to consider specific procedures to test the reliability and integrity of that digital information. Here's a crucial concept, a passkey really. Audit objectives remain precisely the same, whether a company operates in a highly computerized or a predominantly manual environment. The ultimate goal is always to provide assurance on the financial statements. However, the approach to achieving those objectives changes significantly when IT is involved.
How so? What falls under IT infrastructure?
Right. Let's talk about IT infrastructure. This refers to the multiple layers of technology that support significant business processes and the initiation, recording, and reporting of transactions. This includes the hardware, like servers, computers, data centers. It also covers software, which can range from general financial reporting applications to comprehensive enterprise resource planning, or ERP, systems that integrate various business functions like sales, production, finance. The network is vital, encompassing internet connectivity, firewalls, security measures. The operating system manages system resources and hardware. And data storage could be a traditional on-premise infrastructure or maybe a cloud-based solution.
So how does the auditor figure all that out?
To understand this complex environment, the auditor performs risk assessment procedures like touring the entity's facilities to observe IT operations and conducting extensive inquiries of IT personnel. It's critical for an auditor to meticulously document their understanding of the entity's IT environment, specifically detailing the IT applications used to process information, the supporting IT infrastructure, and how technology impacts individual transactions. This detailed documentation is typically integrated into the auditor's overall understanding of the business process, its associated risks, and the identified controls.
And the risks associated with using IT.
Understanding risks from IT use is also paramount. The auditor obtains a deep understanding of the entity's specific uses of IT, including the applications and the inherent risks that arise from such use. They then assess the general IT controls implemented by the entity to address these risks, things like controls over system access, program changes, or data backups. This understanding has several critical impacts on the audit strategy. It directly influences the auditor's decision about whether to test the operating effectiveness of controls to address specific assertion-level risks. It affects the auditor's assessment of control risk and inherent risk at the assertion level. It directly shapes the auditor's strategy for testing information that is produced by or involves information from the entity's IT applications. And ultimately, it guides the design of all further audit procedures.
No company, no matter how big or small, operates in a vacuum, right? What external forces are auditors looking at that can profoundly influence a company's financial picture?
You're absolutely right. Relevant external factors impacting entities are just as crucial as internal workings. Auditors must understand the broader external conditions that are beyond the entity's direct control but can significantly influence its operations and financial statements.
Okay, like what sort of things?
Let's go through these. First, industry factors. This covers industry conditions like the competitive environment, the intricate relationships with key suppliers and customers, and general market dynamics. Auditors consider cyclical or seasonal activity. Think the retail sector during holiday seasons or the fluctuating cost and supply of energy. They look at the overall market demand, industry capacity, and the intensity of price competition.
Right.
Then there are regulatory factors, encompassing the legal and political environment. This includes environmental requirements impacting the industry, general laws and regulations, and taxation policies, both corporate and other types, like sales tax or property tax.
Government policies, too.
Yes, government policy factors relate to the decisions and actions a government entity takes that influence politics, business, and the overall economy. This includes government spending patterns, government taxation policies, interest rate policies set by central banks, the general political stability of the regions where the entity operates, and requirements for licenses and permits that directly impact the entity's ability to conduct business. The financial reporting framework factors are the very guidelines for preparing financial statements. This means understanding the specific accounting principles the entity must follow, such as GAAP or IFRS, and the framework of any regulated industry it might operate in, including specific disclosure requirements. It also considers any industry-specific accounting practices that are common and accepted.
And technology again.
Yep, technology factors are also highly relevant externally. These are ways that technology directly affects the entity's industry and operations. This can include automation of processes, the connectivity and accessibility to the entity's information systems, cybersecurity concerns, and the technology embedded within the entity's products or services.
Supply chains seem huge these days, too.
Absolutely. Supply chain factors represent the entire intricate system of producing and delivering goods and services, from sourcing raw materials to reaching the final end users. Auditors consider potential bottlenecks due to political risks or government instability in sourcing regions, compliance with contracts along the supply chain, cybersecurity concerns that could disrupt supply, issues with product quality from suppliers, and general shortages and logistical delays.
And finally, the big one, economics.
Finally, economic factors, which are incredibly broad and powerful. These encompass elements of the economy overall, or macroeconomics, and elements related to the economy's impact on individual goods and services, or microeconomics. This includes the dynamics of supply, demand, and price elasticity for the entity's products, the impact of broader business cycles and trends in gross domestic product, or GDP, growth, various economic indicators, leading, coincident, lagging, exchange rates and currency revaluation for international businesses, inflation and general price levels, and interest rates and the overall availability of financing.
And if we connect this to the bigger picture, these factors directly influence a company's ability to operate and its financial health, right?
Exactly. These factors directly influence a company's ability to operate profitably, its financial health, and the fair valuation of its assets and liabilities. For an auditor, a sudden drop in, say, building permits doesn't just mean fewer homes being built. For a building supplier client, it might signal an impending inventory valuation crisis, requiring them to look very closely at asset impairments even before the financial reports show a slowdown.
We just talked about economic factors as a key external force. To truly grasp their impact, auditors don't need to be full-blown economists, but they definitely need to understand how fundamental economic concepts play out in the real business world. This is where you get a powerful shortcut to connecting those dots.
That's right. For an auditor to truly understand how external economic factors ripple through and affect an entity's financial statements, a working understanding of key microeconomic and macroeconomic concepts is absolutely essential. It's the core context for everything we've just discussed regarding external forces, helping them anticipate financial statement risk.
So let's zoom in on how individual companies and markets respond to these economic shifts. Microeconomics first.
Yeah, let's start with microeconomic concepts. A foundational aspect is supply and demand. Auditors leverage their understanding of supply to assess if a company's production capabilities align with market demand and pricing, scrutinizing inventory levels and future revenue projections for inconsistencies.
Like if costs go up.
Exactly. For instance, if a raw material supplier suddenly faces a surge in production costs, perhaps due to global energy prices, that directly impacts their ability to supply goods profitably, an auditor would immediately look at their inventory valuations and potential impact on future revenue recognition.
And demand.
On the demand side, auditors consider how factors like consumer income, the price of substitute or complementary goods, consumer preferences or expectations, can shift demand for a company's products. For example, if a key competitor dramatically lowers its prices, the auditor will anticipate a potential decrease in demand for their client's product, leading to questions about sales forecasts, inventory obsolescence, and potential impairment of assets. Okay. Market equilibrium is where supply and demand meet. Auditors watch for shifts in this equilibrium because they directly impact a company's revenue and cost structures. A change in the market equilibrium price, perhaps due to a new competitor or a technological breakthrough, forces auditors to assess how the company's financial statements, particularly revenue and inventory, reflect this new reality.
And this elasticity thing sounds like understanding how much a company's sales might wiggle when market conditions or prices change, right?
That's a perfect way to describe elasticity. It's a crucial concept for auditors because it measures how sensitive the demand for or the supply of a product is to changes in price, income, or the price of other goods.
Okay.
Price elasticity of demand helps auditors understand how much a company's revenue might be impacted by price changes. For a company selling a highly elastic product, one with many substitutes, like a common consumer electronic, even a small price increase could lead to a significant drop in sales volume and revenue. This might make an auditor scrutinize revenue recognition more closely if management is aggressive with pricing.
And inelastic.
Conversely, an inelastic product, like maybe a life-saving medication, means demand isn't highly sensitive to price, which impacts how an auditor views revenue stability and pricing power.
What about supply elasticity?
Price elasticity of supply helps auditors assess a company's ability to respond to market changes. If a company's supply is highly elastic, meaning they can easily ramp up or down production, perhaps because products are easily stored, it impacts how an auditor views their inventory management and capacity utilization. For inelastic products, like perishable goods or those with long production cycles, auditors will look closely at inventory spoilage or lost sales opportunities.
There's cross-elasticity, too.
Yeah, cross-elasticity helps auditors understand the competitive landscape and product interdependencies. If a client produces a substitute good and the price of a competitor's product changes, an auditor needs to assess the impact on their client's sales and market share. Similarly, for complementary goods, a price change in one product might affect the demand for the client's associated product.
And income elasticity.
Finally, income elasticity informs auditors about how a company's sales might fare during economic ups and downs. For products where demand increases significantly with income, normal goods, auditors will look for potential revenue volatility during recessions. Conversely, for products whose demand falls as income rises, inferior goods, auditors will consider if a company is overly reliant on a particular income segment.
Okay. And profit maximization.
Underlying all this microeconomic behavior is the goal of profit maximization. Auditors understand that companies strive to maximize profit, which theoretically occurs when marginal revenue, the revenue from one additional unit, equals marginal cost, the cost of producing that one additional unit. This principle helps auditors analyze cost structures and revenue streams, looking for efficiencies or inefficiencies that could lead to misstatements in profitability, especially if management is under pressure to report high profits.
Now, let's pull back and look at the whole economy, the macroeconomic tides that lift or sink all ships, affecting pretty much every business.
Indeed, that takes us to macroeconomic concepts. A fundamental one is business cycles. While the economy generally grows over time, this growth isn't stable. Business cycles refer to the recurrent rise and fall of overall economic activity relative to long-term growth trends. They're characterized by distinct phases, and auditors must understand which phase impacts their client's industry.
What are the phases?
Well, the expansionary phase reflects rising economic activity. During this period, you typically see rising profits for businesses, strong overall economic growth, increased consumer and business demand, generally rising prices, and lower unemployment rates as companies hire to meet demand.
Good times, mostly.
Generally, yeah. For an auditor, this might mean less risk of asset impairment, but maybe increased risk of aggressive revenue recognition or internal control breakdowns due to rapid growth.
Then the peak.
Next is the peak. This is the high point of economic activity, where profits are often at their highest levels. At the peak, firms often face capacity constraints and input shortages, which often leads to higher costs and higher overall price levels, sometimes signaling inflationary pressures. Auditors here would scrutinize cost of goods sold, inventory values, and potential overvaluation of assets. Following the peak is the contractionary phase. This reflects falling economic activity. Growth slows down or even decreases. Businesses experience falling profits, reduced demand from consumers and other businesses, and an unfortunate consequence is higher unemployment as companies cut back. Yeah, auditors will focus on going concern risks, asset impairments, and potential for management to manipulate results to hide declines.
And the bottom.
The lowest point in the cycle is the trough. Here, economic activity is at its lowest. Profits are at their lowest levels, and firms typically have excess capacity. At this point, companies are often forced to implement severe cost reductions and significantly reduce their workforces. Auditors focus intensely on liquidity, debt covenants, and valuation of assets.
Then recovery.
Finally, the recovery phase follows the trough. This is where economic activity begins to recover. You see rising demand again, profit stabilization starts to take hold, and there are increases in employment as businesses cautiously begin to expand. Auditors would look for appropriate recognition of any restructuring costs and the reestablishment of healthy financial performance. Understanding these cycles helps auditors contextualize a company's financial performance within the broader economic narrative, identifying areas where management might be under pressure to smooth financial results.
So how do economists and auditors actually get a sense of where the economy is headed or where it's been to gauge these tides affecting their clients?
They look at economic indicators, which are basically statistics historically correlated with economic activity. These indicators are crucial tools used by economists and analysts, and by extension, auditors, to predict the timing, severity, and duration of business cycles. They provide vital clues about the economy's direction and therefore a company's operating environment.
Okay, what types are there?
We categorize them into three main types. First, leading indicators. These can predict economic activity, changing before the overall economy starts to follow a certain trend. They're the early warning signs.
Crystal balls.
Sort of. For example, building permits are a classic leading indicator. For a construction company client, a significant drop in permits suggests a slowdown in future sales, prompting an auditor to immediately look at their inventory levels and potential impairments of long-lived assets even before official financial reports show a decline.
Oh.
Other examples include average consumer expectations, weekly manufacturing hours, unemployment claims, the bond yield curve, interest rate spreads, and new orders for capital and consumer goods. The Producer Price Index, or PPI, for finished goods can also signal future inflation at the wholesale level. These are the tea leaves that hint at what's coming.
Got it. What's next?
Second, we have coincident indicators. These change at approximately the same time as the whole economy, providing real-time information about its current state. Examples include industrial production, which measures the output of manufacturing, mining, and utilities, and manufacturing and trade sales, which give a broad measure of economic activity across those sectors. Gross domestic product, or GDP, also falls into this category, measuring national output. These indicators help auditors confirm current economic health and its impact on a client's reported revenue and production.
And the last type.
Finally, lagging indicators. These tend to follow economic activity, changing after a given economic trend has already started. They are primarily used to confirm or dispute previous forecasts made by leading indicators, providing a look in the rearview mirror, so to speak.
Like confirming what happened.
Exactly. Examples include the average prime rate charged by banks, the average duration of unemployment, commercial and industrial loans outstanding, the Consumer Price Index, or CPI for services, reflecting inflation in service sectors, the Consumer Installment Credit to Personal Income Ratio, labor cost per unit, and the Inventories to Sales Ratio. These indicators help auditors contextualize a company's historical financial performance within the broader economic narrative, confirming if past financial results align with established economic trends. So, what does this all mean for you, the listener? We've covered this immense scope of understanding required for an audit, really. From the precise nuances of internal operations and management incentives all the way to the broad strokes of global economic forces. It's truly about building a holistic, dynamic picture of an entity. This isn't just about ticking boxes on a checklist. It's a comprehensive, ongoing investigation to determine if the numbers truly reflect reality.
Yeah, and for you, the learner, remember these key takeaways. Auditors don't just check numbers, they deeply understand the why and how a business operates within its specific environment. They use a powerful blend of detective work, through inquiries and observations and rigorous data analysis with analytical procedures to proactively spot risks.
Right.
External factors, everything from industry trends and regulatory changes to broad global economic shifts, are just as crucial as internal controls in assessing a company's financial health.
Absolutely.
And understanding how basic economic principles play out in the real world is what helps auditors connect the dots between those vast external forces and a company's specific financial statements.
And maybe this raises an important question to leave you with. Given the relentless evolution of technology, global markets, even climate change impacts, how might this whole process of understanding the entity and its environment continue to adapt and innovate in the coming years? What new data streams will emerge, and how will auditors leverage advanced analytics, maybe even artificial intelligence, to deepen their insights and anticipate risks even more effectively?
That's a great thought to ponder. We really hope this deep dive has given you a powerful shortcut to being truly well-informed on this critical aspect of audit and business understanding. Until next time, keep diving into knowledge.